They call themselves the moneymakers. They're a small, exclusive group of investors who have quietly amassed fortunes beyond your wildest dreams. But what sets them apart isn't just their wealth. It's their secret strategies, the insider tips that have turned ordinary people into extraordinary investors. In this video, I'm going to reveal 10 guaranteed investing strategies that most people don't even know exist. These are the same tactics used by some of the most successful investors in the world, methods that have been fine-tuned through years of research and real-world success. But this isn't just about making money. It's about achieving financial freedom, gaining control over your life, and building a legacy for generations to come. So, if you're ready to take your financial future into your own hands, stick around until the end of this video. I promise you won't be disappointed. Number 10. Diversification. Diversification is a tried and true strategy for anyone looking to build wealth and secure their financial future. The idea is pretty simple. Don't put all your money into one investment. By spreading your money across different types of investments like stocks, bonds, real estate, and even some newer options like cryptocurrencies, you can reduce your risk. It's like having a backup plan for your backup plan. If one investment doesn't do so well, others might pick up the slack, keeping your overall financial picture in good shape. This approach isn't just for the wealthy. Everyone can do it, whether you're just starting out or have been investing for years. The key is balance. By having a variety of investments, you're not just hoping for one big win. You're creating a steady path to growth. It's a strategy that works because it's based on common sense. The more you spread out your risk, the better your chances of seeing steady returns over time. There's no need for flashy moves or high-stakes gambles, just smart, steady investing. Number 9. Make realistic goals. Investing without clear goals is like setting out on a trip without a map or a destination. You need to know where you want to end up financially before you dive into the world of investing. It means figuring out what you want to achieve, how much money you have to invest, what kind of returns you're aiming for, and how long you're comfortable keeping your money in the market. Once you've laid out your investment goals and strategies, it's crucial to stick to them. It can be tempting to make impulsive changes when you see short-term fluctuations in your portfolio. But remember, these small ups and downs are usually just noise in the grand scheme of things. Your focus should remain on your long-term objectives and not get sidetracked by temporary market movements. Number 8. Start early investment. Investing early is a smart strategy for building wealth because it allows your money to grow over a longer period of time. The power of compound interest is at work here. This means that the returns you earn on your investments are reinvested, generating even more returns. The longer your money is invested, the more time it has to compound, leading to significant growth over time. Additionally, starting early can help you weather market fluctuations. If you invest for the long term, you're less likely to be overly concerned about short-term market downturns. Over time, the market tends to go up. So staying invested through both good and bad times can pay off. Number 7. Make small but regular investments. Steady investing works best. Small amounts add up over time. This is key to successful investing. Keep putting money into your investments regularly. Even small sums can grow into a good amount. You don't need a lot of money to start. Pick an amount you can afford and really stick to it. Maybe it's $20 a week or $100 a month. The amount doesn't matter as much as being consistent. This method is like filling a piggy bank. Each deposit helps, no matter how small. Over time, these small deposits grow into something bigger. It might seem slow at first, but keep at it. The results can surprise you. Your money has time to grow and compound, and this is exactly how small, regular investments can turn into solid savings over years. Number 6. Focus on overall returns. When it comes to investing, it's important to focus on your overall returns rather than getting caught up in the short-term ups and downs of the market. If you're relying on your investments for regular income, the daily fluctuations in value of assets like stocks or bonds are less significant. What really matters is whether you're receiving the steady income you need. Financial experts say that if you're still receiving regular income and there's no fundamental change in the borrower's creditworthiness, there's less reason to panic if the market value of your investment goes down, especially if you're holding onto a bond until it matures. The key is to stay focused on your long-term financial goals rather than being swayed by temporary market changes. Number 5. Stock investment. When you invest in stocks, you're essentially betting on a company's future success. Stocks can offer substantial returns, but they come with risks. The value of your shares can fluctuate based on the company's performance, market conditions, and broader economic factors. To get started, you need to decide on which stocks to buy. You can do some research on companies by looking at their financial health, industry position, and future growth prospects. I'd like to keep emphasizing the word future because remember, stock investment is best approached with a long-term perspective. The market can be volatile in the short term, but historically, it has tended to grow over the long run. Number 4. Invest in dividends. Investing in dividend stocks means you're buying a slice of a company and earning parts of its profits through dividend payments. These dividends are essentially cash rewards that companies give to their shareholders, and they typically come through on a quarterly, semi-annual, or annual basis. Scott Sturgeon is a certified financial planner or CFP and is also the founder of Oriad Wealth Partners. He explains that dividends act as an incentive for shareholders, similar to interest payments on a bond. He says, because these companies have been around for a long time or have name recognition, they could be viewed as a little more conservative. These well-established companies, known as value companies, usually have a steady cash flow and don't need to reinvest all their earnings into growth, which is why, as an investor, you are able to receive profits that they share, known as dividends. Number 3. Invest in wealth creation funds. Investing in wealth creation funds can be a more strategic move than putting your money into individual shares. Instead of trying to pick the winning stocks yourself, you're essentially handling that task over to the experts who manage these funds. Stocks and bonds make up the backbone of these funds, offering a more diversified and often less risky way to grow your wealth. One of the big advantages of wealth creation funds is that they give you access to a broader range of global investment opportunities, often at a lower cost than buying individual stocks. Think of it like this. Instead of placing all your bets on a single horse in a race, you're spreading your risk across multiple contenders. This diversification helps cushion the blow if one particular investment doesn't perform as expected. Here's an example. Let's say we're interested in tapping into the growth potential of leading technology companies. Rather than trying to choose the best individual stocks yourself, which can be both risky and time-consuming, you might opt for a fund that focuses on technology equities. This way, you're not only investing in some of the biggest names in the tech world, but you're also spreading your risk across various companies within the sector. Wealth creation funds are managed by professionals who have the experience and resources to analyze the market, making informed decisions on where to invest. It can be especially beneficial if you're not keen on spending hours researching individual stocks or if you're looking for a more hands-off approach to investing. Number 2. Don't try to time the market. Trying to time the market is like when you're surfing and you're trying to catch that one perfect wave. It's unpredictable and often frustrating. The idea of buying and selling based on short-term market movements is tempting, but it's a tricky game that even seasoned investors struggle to master. The market is inherently volatile, and predicting its ups and downs with precision is nearly impossible. Often, those who attempt to time the market end up missing out on gains or making poor decisions during downturns. Instead of focusing on when to enter or exit the market, it's generally more effective to adopt a steady and long-term investment strategy. Number 1. Value investing. Value investing is like finding hidden treasure in a market that others have overlooked. The basic idea is to buy shares in companies that the crowd has turned its back on, but that you believe still have strong potential. The trick is spotting these opportunities before the rest of the market catches on. You're essentially betting that the current share price doesn't reflect the company's true worth. When a company's shares are undervalued, it usually means that the market's view of its future is overly pessimistic. But with your understanding of the market and experience, you might see something others don't. You believe you're getting in at a bargain price, anticipating that the share price will eventually rise as others recognize the company's true value. Alright, that's it for this video. Now if these strategies hit the mark for you, make sure to subscribe and ring that bell. This way, you'll never miss out on the next big tip. Catch you in the next one.